Good morning. It's 9 a.m. here in Hong Kong, just half an hour away to the opening bell here in the city, in Shanghai, and also in Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Jewelers.
Our top stories this hour: Asian stocks under pressure following declines on Wall Street as trade fears linger at trumping robust U.S. economic data.
Now, President Trump says he will sign a natural resources deal with Ukraine soon as EU leaders struggle to formulate a strategy for Kyiv.
Results season kicks into high gear with Temu owner PDD reporting a faster-than-expected rise in earnings. Food delivery giant Meituan also on deck with investors focused on its overseas expansion.
Yeah, and speaking of earnings here, a stacked slate of exclusive interviews coming up here on the China Show. We're speaking with the executives from Sin Tong Kai and Company, Stella International, and also Kingsoft Cloud.
Well, Dave, I've got to say, when I take a look at the board here, the Asian equities are kind of just petering out into the weekend. I think everyone's sort of ready for this break because we came into the week and actually things were looking pretty positive. We saw sort of a bit of a correction from Wall Street that was started last Friday, extended into Monday, but it's certainly really given up. We came into the week as well with a lot of central bank decisions on tap, and going into it, we knew what the expectation was, which was pretty much don't expect too much because we saw a lot of holds, we saw a lot of waiting, a lot of signals that we've got to wait for further clarity as well. And so that has really come across that traders still really don't have too much in terms of what's going to be setting the direction. So you can see that reflected very much in the session today. Asian equities are flat, US futures flat, dollar little changed. Also really not seeing too much direction coming through in treasuries and the broader bond space. Let's change on. A Golden Dragon Index, of course, to note because earnings were still coming through. China numbers, of course, lots of different ones on tap. Again, that similar story being reflected in the Golden Dragon Index. Big pop to start the week, but given that we saw it nearly dropping 4% overnight, again, it's that same story. We're kind of pretty much net no changes based on the week. Let's quick change on. Take a look what's expected in futures today. Again, a little bit more downside pressure coming through. It does seem that maybe we've got a little bit of short-term bullish fatigue. That's the point that Mark Cranfield is making on the MLive blog. But still, broadly, the direction is to the upside for a lot of these names still. I think BYD, for instance, really stands out, up nearly 60% so far this year. It's still that bigger picture around Chinese innovation and sort of that re-rating on that potential as well.
Yeah, and I think that we get, of course, earnings coming out next week. I think we have over $2 trillion $2 trillion US dollars in market cap next week. But before we even talk about that number, we have over 250 billion, roughly speaking, in US dollars of market cap reporting today. We'll get you a preview of Meituan in just a moment. Bocom is coming out. This big miner, of course, in China, which has done exceptionally well on the stock price itself. We're talking about gold. You talk about Zijin Mining, right? Miniso, China Coal Energy, among the other companies coming out with earnings today. Plus, of course, all the reaction from everything that came out after the bell. Yes, and we'll get into all of that in a moment, going into a week where, as Bell was pointing out, we're effectively trading sideways going into this final trading session of the week.
Yeah. But, of course, still that big focus on earnings, as you said, and one of those is the Chinese food delivery platform, Meituan. It's projected to keep up a 4-year streak of at least double-digit percentage growth. That's when it announces December quarter numbers. It's mainly due to the expansion of its business within China, also abroad. Let's bring in our China correspondent, Min Lo, and kick us off. Earnings preview. What's exactly expected?
Yeah, so pretty upbeat. Its revenue expected to have grown by close to 20% on year in the fourth quarter, largely because of its overseas expansion plan. Anyone in Hong Kong would be familiar that Deliveroo is now exiting the market after Kita came in, and investors will be looking forward to whether Meituan will be able to keep up with this trend in its overseas push beyond Saudi Arabia and Hong Kong. But domestically as well, its commerce business also expected to see margin gains on the back of stronger volume of orders, lower unit costs, a better improvement in its delivery efficiency. And then plus, Meituan has also been coming up with a few new initiatives, including a push into grocery retail. It has a new Insta shopping platform, which is an on-demand retail platform that has managed to attract new users, increase frequency of purchases after the platform had attracted new sellers, more product offerings, a tie-up with Walmart. But we're still expecting to see some losses in some of these new initiatives in 2025, potentially beyond that as well. The company's executives had said they will continue to double down on its overseas expansion, the grocery retail segment, and tech. And investors are pretty upbeat. The average price target is a 30% upside to the current price. And some investors are saying that this could be a stock with the biggest return potential this year because it's been lagging behind the Hang Seng Tech year to date, even though last year, if you look at 1 year ago, it's really almost doubled its value, about 90% over the past year.
Tell us about the other company that reported, Pinduoduo. Out with earnings, I think it was a miss, and just the market reaction as well.
Yes, it was a very volatile day yesterday because the revenue miss coming in at 24% versus estimates of 30%, but earnings was a beat, the net income at 18%. So actually yesterday at the US session, it opened in losses but closed the day 4% up. But then after hours, Nomura came out with a note downgrading that stock from a buy to a neutral. And then you saw after hours, the stock giving up its losses. It's trading at about 0.5% down. Nomura also is lowering the price target to 130, which is essentially where the stock is trading at right now. And the company executives talked about a number of headwinds. One is the geopolitical uncertainty, and secondly, the domestic competition. And actually last year already in August, we had that PDD profit warning because of competition from JD.com and Alibaba, which both had hit better than projected earnings on the back of the government subsidies. And then externally, of course, the potential revoking of the de minimis rule, threatening to eat into margins because already the company has to start to move items in bulk to the U.S. and pay tariffs for that, store it in overseas warehouses. That obviously puts pressure on its discounted prices. So not as upbeat on the outlook, although Morgan Stanley is saying that the earnings beat could restore confidence on its earnings outlook. But JP Morgan, though, is saying that there's no bright spot in the earnings call yesterday at all.
Okay, and on that positive note, we'll leave it there with Min Min Lo going into the 23 minutes away from the opening bell. Let's talk geopolitics now. So it was a big, in case you missed that, waking up in the Asia Pacific, what is new with the world? Well, a lot. President Trump saying that he will soon sign this natural resources deal with Ukraine. Now, the agreement fell apart, of course, last month after that tense meeting and exchange between Trump and Zelensky, of course, at the Oval Office. Let's bring in John Herskovitz, our East Asia government editor, to get us up to speed right now. He joins us out of Tokyo this Friday morning in the Asia Pacific. John, get us up to speed. What is going to be in that mineral deal, and how is this going to work?
Sure. The minerals deal, as you mentioned, was the one that fell apart last month. The deal calls for half of the future revenue from Ukraine's minerals to go into this fund for reconstruction and for security. The minerals under contention are things like iron ore, coal. These are things that Ukraine produces. And this is just one of the two things that Trump talked about today. He also signed an executive order for critical minerals for the U.S. to increase production there, speed up licensing things, and also doing this for critical minerals and for rare earths. Now, the thing about critical minerals, these are things which are essential for the economy. Rare earths are used in things like technology, batteries, and these deals are part of the way that Trump is seeing to ensure that supply chains are secure. A lot of these supply chains depend on China. We're seeing Trump ramping up trade difficulties, trade tariffs with China. And by doing these separate deals, Ukraine and critical minerals, I think the idea is to make sure that the U.S. supplies are firm and that the supply chains are much more stable than they once were.
And from the European side or the EU side, the concern, of course, is that they're essentially being left out of these efforts from Trump and from the US. So we know that there's been another meeting of EU leaders, but there are still a lot of sticking points as well from their approach.
Exactly. There were two main sticking points from the meeting that was just held in Europe. The first one was who's going to represent the EU at the talks with Ukraine. There was no consensus as to who would be the representative for the bloc in the talks that have mostly been between the U.S. and Russia, and also with the side meeting with the U.S. and Ukraine. So that was the first thing. The second holdup was about weapons supplies. There was a proposal to supply Ukraine with about 5 billion euros armaments ammunition by the end of the year. And this also hit a roadblock with a couple of countries objecting to specific aims for the ammunition supplies. Bloomberg spoke to some officials there. They're expecting a meeting next week in Paris, and perhaps some of these things can be ironed out at the next meeting.
Yeah, certainly aims to get some sort of renewed commitment agreed to continue supporting Ukraine. That was Bloomberg's John Herskovitz there in Tokyo. And up next, we're going to be getting the outlook with Sun Hung Kai & Co. That's after the investment firm went from a loss in 2023 to posting a profit last year. Counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. 20 minutes away, futures are looking like we could come a little bit under pressure. You're watching The China Show.
Welcome back. We're going into, 17 minutes into the Friday session. We're in the thick of earnings season here. One of the companies that did come out with earnings, of course, this week, very, very recently, Sun Hung Kai & Co. has swung back into profit, in fact, in 2024 after a loss the year before. Tony Edwards is the executive director and deputy CEO of the company, and is joining us here exclusively on set for a chat on the results. It's nice to see you, and good morning.
Good morning, David. Nice to see you.
You guys did very well last year.
Yeah.
Fair to say?
Absolutely. It's been a real business transformation year for us.
Yeah. What happened?
What drove our earnings? We announced about $377 million of profit attributable to shareholders. Was our investment management division, our funds management division, which manages external capital, and our credit platform, our consumer credit platform, UA, all doing really well. And it's really a testament to the way we've driven a change in the business over the course of the last 12 to 18 months. On the investment management side, it was really our hedge fund investments that really drove returns last year, and they added they contributed about $390 million on the investment side. But in our external capital, that's really where we saw the growth. We doubled our assets under management from third-party clients, and now it's 80% of the money within that group is external capital, and that's come from our leveraging the alternative capabilities of the business in terms of our investments. But also our consumer credit business did really well. Although loans were slightly lower at about 11 billion, that's because of the economic hardship, but also tighter underwriting. They still contributed $807 million to the business. And launched and did a great job a new credit card, SIM card, which has seen a balance now of about $1.5 billion come into the business, and also a new source of customers through the app there. So it's been a great year and a great transformation.
So the alternatives part of the business in particular, which you're saying contributed really a lot of the growth, which part of alternatives in particular?
Well, we've been really focused for the last 15 years or so investing in alternatives, and what we've done this year is really take that expertise, those relationships, that advice, and leverage that into third-party capital. So we've grown our family office solutions business by about 12 families now. There's about another 250 million US of assets there. So as I said earlier, I think our third-party capital and our own business is about balanced, about 15 billion Hong Kong each. But really, we've used that and our strong governance and alignment. So really, we only advise clients to invest in investments that we've invested in. So we're not an agent. We don't do transactions. We invest from a risk-return perspective, which means we seek a lot of downside protection, asymmetric returns, and clients really like that, particularly with the uncertainty at the moment. I mean, who can predict what's going to happen tomorrow, let alone in 6 months' time? But what we do in our investments and our partnerships, like with Actus Ray, which is a market-neutral public quant hedge fund, and they have just provided returns month after month after month, really consistent, and they've seen their assets grow in the last 3 years from zero to over $1 billion US, and continuing to grow because clients want those sorts of tangible outcomes, and our business transformation is about those tangible outcomes.
Yeah, in some sense, the predictability really of being able to count on those monthly returns. Talk to us about private credit.
Yep.
That's still a big thing for obvious reasons. We talk about that a lot increasingly here on the shows. And how are you guys getting more involved in that?
Yeah, private credit is a part of our heritage. We've been in Hong Kong for 55 years and involved in the credit space for all that time. And we've recently announced a new partnership with Wentworth Capital in Australia, and we're very excited about that. We've been investing in private credit in Australia for many years. And what we seek to do is access really good talent that's unique and has a very strong value proposition for ourselves and for our clients, and provide them with the resources, whether it's seed capital or credit capital, to really exploit the opportunities they see it. And Australia is great because the banks are retrenching from lending to property and all types of property. There's a strong immigration into Australia, sort of 500,000-600,000 people a year, and the development process is still very opaque. And that's where people with expertise and background can exploit those opportunities. And I think we're uniquely positioned in that regard because we've also a very resilient balance sheet. We've seen our net gearing fall to 31%, and we've been buying back our bonds. So our interest cover has also risen by 80% to nearly 2 times this year. So that's really important to us because that allows us to exploit the dislocation in the markets and take advantage of those opportunities. And what we're doing differently in terms of the transformation is using those opportunities and providing them to third-party capital, family offices in Hong Kong and ultra-high net worth individuals who really want to do something different and invest alongside an investor like ourselves. Because we probably have, 200-300 years of experience in our investment teams combined in the alternative space.
I was going to ask you about that too, because it seems because of the dislocation in markets, which you alluded to, you then have these returns on the table for people who understand the market. 15%, for example, right? Private credit. And I want to understand how much capital you think you're prepared to deploy. That's number one. And do you think it's a risk that there are so many new players coming into the market that might not understand how things work? I can't seem to figure out what the risk is with a 15% return on the table.
Yeah, well, it's not about the return, it's about the risk. And it's about using your experience to understand what the downside is and how you protect yourself from the downside and how you create the opportunity for asymmetric returns in the future. And what we're doing with our business transformation is teaming up with third-party capital, and we're leading that investment and investing with them. So there's a really strong alignment. But you need, particularly for example, in property, you need to be a local player because property as an asset class is a very local asset class. Yeah. Hedge funds are not, but what we do we have a similar approach. Whether it's hedge funds, special situations, private credit, we spend a lot of time analysing and using our experience, getting the data to set up that sort of asymmetric approach to the opportunity. And for example, last week when there was a big dislocation, a lot of leverage in the markets, an unwinding in very crowded trades, our 2 hedge fund partners, the Actis Ray and also Latitude, which is our own hedge fund of fund, another very strong returns last year. And again, last week, just sailed through. And it continued to print some really good returns.
And these are market neutral?
They're properly market neutral. So I think of it like, David, risk-return investing is like if you set out on a journey, checking out the weather before you go. But if you're just going to invest in the markets and invest in beta, you're just going to get pushed around by external events and the weather. And I think the approach we have in terms of looking at risk and looking and understanding price, that has a lot of information in it, that makes us smarter, and we're able to have those tangible outcomes that our clients and our shareholders want.
The investment thesis and thinking about sort of the weather, because a lot of the conversation we have as well is about sort of the ending or the eroding of US exceptionalism and opportunities that are opening up, for instance, in China, but other markets as well. Are you changing your approach at all for this coming year?
Our approach is always to maintain a lot of resilience, a lot of optionality in what we can do. It's that we're in the best shape we can be to take advantage of the opportunities as we see it and the experience we have. And I think a testament to that is over the last 25 years or so, we've returned over $15 billion to our shareholders in the forms of dividends, and we announced another strong dividend last night. And I think that's key to us, is that shareholders benefit from our capabilities and our expertise, as well as our clients and the balance sheet.
Tony, fantastic to speak with you.
Lovely to speak to you.
Let's do it again soon. Tony Edwards there, out of Sun Hung Kai, the Executive Director and Deputy CEO. Going into the open today, just under 8 minutes away, and we're called lower half of 1% on the Hang Seng Index. We're trading sideways for the week. For once, really. 7 minutes to the open. This is the China Show. Good morning. All right, happy Friday. So half of 1% going into to the downside here, going into the Friday session. Yeah, we're generally lower across most benchmarks, if not all, in Hong Kong. We're slightly higher, though, still, and we'll see how the day pans out on the Shanghai Composite going into the weekend. But yeah, we've been trading sideways. There's not been a lot of volume coming through. Turnover in the mainland has been coming down as well. We're in the thick of earnings season as well, too.
Yeah, and of course, really one of the big names for today, at least, is Meituan, which is going to be reporting later, and a little bit higher. But of course, yeah, we're not really expecting too big a moves in either direction ahead of the numbers. But they are expected to be good, because this estimate is for sales to have increased almost 20% in the fourth quarter. That actually would be the smallest growth that they've seen in 2 years, but still the margin is expected to improve at the business. And there's also going to be a big focus on how they're going against what's really continues to be a lot of competition in this space as well, because JD, for instance, just recently launched their own food delivery business as well. Geely, another one to be noting, because as well it's going to be seeing reaction to its results.
It's gone up 3 times on the earnings here, which is interesting, because if you juxtapose that against one of its peers in the industry, which is BAIC Motor, they're actually feeling the pinch of competition. It's the other side of the same coin, and NIO, I think, comes out later today. But yeah, I mean, generally speaking, the dynamic we've seen so far, majority of the time this week, has been good earnings, not a lot of reaction in the market, and that's probably because these, some of these names are up 20-30% already before these companies had already reported. So I guess to answer the question, had it been priced in? Yes, as far as the earnings story goes. Okay, CK Hutch, very, very quickly, we're looking at that too, going into the open today, out with earnings and 2.7% to the downside. The company has acknowledged, and I'm borrowing the statement here from the chairman, Victor Lee, that the operating environment for the business is expected to be both volatile and also unpredictable. There we go. Plenty more ahead. This is Bloomberg.
Welcome back. You're watching The China Show, counting down to the open of mainland markets, Hong Kong this morning. Look, if you're really taking the sentiment that we've got in broader Asian equities, also what happened on Wall Street overnight, it's pretty much trading it sideways and a lack of sort of really obvious catalysts. Even though we still do have Chinese earnings, they just don't seem to be moving the needle that much, it seems.
No, not even good earnings like Tencent, which I'm just using Tencent as an example, right? The blowout set of earnings. We talked with the Barclays guest yesterday who couldn't find anything wrong with the earnings, right? They're giving back a ton of money. They're increasing the dividend, yet the stock fell 3-4%, I believe, into the close yesterday, which I guess in many ways underscores how far we've come to the upside here and what the next catalyst probably will or should be. When you look at this, I mean, case in point, right? So we talk about the Hong Kong markets a lot more closely these days than the onshore markets, because sort of the former has done much, much better. But Shanghai Com, for example, has actually seen quietly higher and higher lows. In fact, at 3,400, we're at about year-to-date highs as far as that specific benchmark is concerned. We're looking at copper, which, again, as you can see on your screens, if you don't, that's top row, third from the left. Should be up again. That's a tariff story. Steel is up 0.3%. There's a separate underlying longer-term conversation around supply-side reforms, again, in some provinces in China as it pertains to supply of steel in particular. Have a look at the open here in Hong Kong. We're sideways, if not down. We're down for the day. We're sideways for the week so far, 2,400. is where we are in the Hang Seng Index. HS Tech is down 1.2. Bottom of your screens, you have, of course, some of the big heavyweights are like Tencent, Alibaba. We are in the thick of earnings season. Meituan reports later today, and we are down 0.5% as far as that specific one is concerned. Okay, let's get through some earnings here. Just bear with me. We're going to go through quite a bit. CK Hutch out with earnings. Not so much the earnings, as you would imagine, is the focus there, but the ports deal, which, suffice to say, has garnered a lot of attention, not just within the company. Let's put it that way. 2.5%. The company has acknowledged, of course, the operating conditions is less than ideal, if you put it that way. Henderson Land also reporting yesterday. That's the company that's property company. Partially blocked our view here. With a fantastic building, I should say. There we go, just to hedge that. Geely Auto was up 3x on earnings. BIC, we talked about this, winding up the opposite here. I think the company reports full year in a couple of days, but suffice to say that drop of, I think it's about 60+% on profit year on year. Flip the page. Brilliance China reports today. GCL Tech reported after the bell yesterday. We'll talk with Stella in a moment there. As you can see, the stock, bright spot there, 1.2% to the upside. Sana Biopharm also coming up with earnings. And just this is a policy-driven move we're seeing across some of the TCM, traditional Chinese medicine stocks, on the back of this guides, this government promotion of high-quality development for the industry. Guidelines being put out promoting the Chinese medicine industry. Yeah, there we go. So from that kind of TCM therapy to maybe luxury and retail therapy, Belle.
Yeah, that's right. They're all types of therapy. And
yeah.
I tell you what, it's you know, as you said, the market has come on a little bit under pressure, but Stella is one that's managing to move a bit higher. That is, of course, the Hong Kong-listed footwear maker. It did report strong financial growth in 2024. We saw a 15.7% rise in operating profit as well. And the company is saying that looking forward, it's not expecting too much of an impact from US tariffs on China on their overall performance. But let's bring in Andrew Tam, he's CFO of Stella International, joining us exclusively this morning. So, Andrew, I mean, we just sort of mentioned some of the highlights there. Thanks very much for joining us in studio. What stood out to you from the numbers in particular?
Well, thank you. You know, this is the second year of our 3-year plan that we've put together and announced to the market. We've been on execution mode the last 2 years. And really about enhancing our customer base, winning new customers. So we won several new customers in fashion and luxury. Very high margin customers and much better in terms of working capital for us, really driving us our return on invested capital. And that's really have kind of led to our more of structural growth, despite you hear all the negative consumer sentiment out there. You know, we delivered 21% net profit growth, way higher than what we targeted for at the low teens and the net income. And as a result of that, we have garnered a lot of the highest cash balance we have on record. And we've announced back in August that we will be distributing some of that cash through an excess cash return program to our shareholders. So we have $420 million in cash right now. We're going to give out $180 million extra on top of a normal dividend over the next 3 years. So just looking at 2024, we are giving up about $1.71. So that's almost about a 10% dividend yield in today's share price. Dividend is up.
Yeah, I think we're flashing some of your customers there, everything from sports, luxury, fashion, and casual. You mentioned you have new customers. Can you tell us who the new partners are?
One sports customer, they're doing their relaunch with Under Armour, with Kevin Plank, CEO, founder, coming back. NBA All-Star Weekend was almost a month ago.
Yeah.
They have a new product with Steph Curry, Masonry, aftermarket luxury car maker. Very interesting product, but that's just the beginning. I think for them, the rest of the product will be coming out for over the next year or two. We're helping them on the product side. Okay, and in addition to that, I think people recognize our product development skill set, and that's why they come to us. And we're looking at other premium sports customer also. Hopefully, end of this year, we can talk about when we finally launch the product. You'll probably see it in the stores. Very exciting, but there's several other customers on a pipeline for us.
Nike was another name that we saw on that board, and we had their earnings, and something that kind of came through, and that was the struggles that Nike continues to face in terms of trying to clear through inventory. Do you see across your customer base any signs of sort of higher than expected stockpiles of inventory, given as well weaker consumer sentiment? Yeah,
our relationship with Nike is very unique because we are more of a higher end premium. We do all the most difficult products for them. And those are typically the limited runs. So typically not you see in the inventory. So we're a very different, unique market. And then with them, even for this year, we're looking at, probably flat for them year on year because they have more products. Actually, as you know, there are new CEO coming in. They want to create fresher products. So there's actually even more product development in the pipeline with them.
Let's talk about the outlook now. A lot of people talk about tariffs, which we can get to directly in a moment here. But just the general outlook is uncertain and clouded. There's several major markets in the world. We'll talk about China in a moment, like the U.S., for example, where consumer confidence seems to be trickling lower because of inflation or what have you. What are you seeing as far as the outlook from your customers? What are they telling you about their sort of inventory plans moving forward? And where are you seeing things okay? Where are you seeing things not okay?
I think in general, overall, most of our customers are looking at the U.S. market, also over global consumer market, cautiously optimistic. No one we can predict what will happen with, impact with the U.S. policies on their own economy, but everyone's cautiously optimistic. The lucky thing we can do is that we've been winning so many customers that over the last few years, we have very diversified customers, over 40 customers, and we can actually, thankfully, reallocate. When one certain customer is weaker, we can actually reallocate the production to someone else.
The capacity, okay.
Exactly. So in this case, this next 2025, we're full. We're completely full for the full year. In a weird way, if there's a cyclical upturn, we probably would be more supply constrained. But we're running in full steam right now.
Yeah, I was going to ask you as well. So across sports, luxury, which segment is doing better than others, and which one has a bit of softness there?
Definitely, I think a lot of people have seen luxury has been weaker. Okay, and that's without saying. I mean, Chinese consumer is a big market for them, so it is definitely slower. What was interesting is that a lot of our fashion customer is actually getting stronger. Okay, now a lot of the fashion brands are probably more tied to U.S. market, but I think it's more unique brand to brand. They have unique product innovation. For example, I'm wearing a pair of shoes from Amiri today. Looks
like
great.
A white shot.
Yeah, I think we can actually show those shoes.
Next time I should stand up, actually, probably.
Oh, there we go.
We have this product that's, a dress shoe, tassel, old shoe silhouette for men's suits, but extremely comfortable. So you'll never slip in the water or on the wet floor or the hills. Much very different than leather shoes from before. So it's something that, we help them productize.
Were you expecting to have your shoes on TV today?
Well, I probably would wear different socks, I guess. I did not know that. Yeah. You caught me on that one. But so,
no socks, man. No socks is the way to go. I always tell it.
Well, so, we have a great product development team that helps our customer in time to productize new product silhouette, but we incorporate new technology that, wasn't around for some of the men's shoes from before. And so that's why we've been able to win new customers. And so we think it's a very structural thing.
We can get to tariffs as well, and just talk us through it. I know you said that you're not seeing too much of an impact, but why exactly aren't you seeing such a bearing on the business outlook from those?
Yeah, it is purely because even, I'll tell you, when we talk about U.S.-China tariff, even the tariff situation, we were surprised. We thought most of our customers have already diversified away from China because we don't work with them in China. And then we got calls from them and said, hey, we still have some factories. We work in China. We just haven't outsourced those production yet. So if you guys have capacity in Vietnam, Indonesia, we would like to kind of strip some of that to you. And so we're, in a way, taking market share because our production is already diversified away from China. And the existing production we have in China is really China for China. Okay, so it's really for the Chinese market.
But are you concerned, though, because obviously the US has these other countries that divert trade in their sights, and so they're looking possibly at levying tariffs as well on places like Vietnam. Are you concerned about that at all?
That's going to be, I think, a concern for production or for brands and manufacturers and also brands all over the world. Because there isn't anywhere else you can, existing factories don't exist somewhere else. So if it's not China, it's not Vietnam, it's not Indonesia, Thailand or India, there aren't more places that have existing infrastructure for that. So I think that would be a different conversation. I think if that does happen, I think, we can only offer diversity for our customer and see how each country will negotiate, of course, with the U.S. government.
As far as customers go, that's interesting. You can tell what the outlook for the economy is. It depends on what the priorities of the customer. What are the number one concerns? So, is it flexibility in the supply chain? Is it your ability to deliver lower cost? Is it your ability to ramp up capacity? What would you think is a common denominator among your customers right now? What is top of mind of all of them, agnostic of what segment of the market they're in?
I would say for us, for Stella, because we're known for high-end quality and product development, number one thing for our customers is quality. And even this year, as we expand our production in Solo, we will have a controlled production. So we want to make sure the quality ensure is actually great. Okay, and that's the thing we want to commit to deliver to our customer. And that's why they come to us. Okay. Now, recently, because of what you've seen in the turmoil and geopolitical, diversification has been number two, and actually maybe more forward than other time before. And we offer Bangladesh, Indonesia, Vietnam, and China and Philippines. So that's why we can actually low balance depending what the geopolitical situation is. Cost is more last point. You know, at the day, once you come to Asia, cost is typically lower already.
The final question, CFO, need to ask you. You mentioned $420 million. In cash. You're giving out $180 million. What is an ideal cash balance for you guys? And how else are you looking to manage your cash?
We look at $180 million cash for the excess cash return. We have another $100 million capex for expansion. That was delayed, I would say, over the last 2 years.
And you're taking that from cash?
It's basically fully funded. We kept it on a balance sheet to fully fund this project.
Okay.
So if you take all the $280 million out, we're slightly below $200 million. And that's probably an optimal cash level. And that's how we determine the excess cash return program in general. Because we don't need all this excess cash. And we want to make sure we give it back to shareholders and have a higher dividend yield for everyone.
And just very quickly, capacity-wise, this year,
This year, we're increasing 5% in terms of production. It's already built. We're just trying to control how we ramp up the production. But in terms of expansion, my CEO, Steve, and I are looking at the next 3 to 5 year plan, where we want to increase new footwear factory, expand into handbag and accessory. So we're building a new factory and looking at new locations that we're going to expand further volume.
Yeah.
I'm curious where those locations are, but I think...
I know. I'm itching to ask. Oh, we don't have time.
Oh, we don't have time. We're out of time.
Next time.
That was next time, That was Andrew Tam there, CFO of Stella International, and sticking with that earnings focus as well in the next hour, because Kingsoft Cloud reported this week, and they're going to be joining us exclusively after it posted fourth quarter revenue that beat estimates. More ahead. This is Bloomberg. Some of the stories that we're following this morning, and FedEx shares fell in the US. That's after the firm lowered its full-year guidance for a third consecutive quarter. The company is facing mounting economic issues driven by inflation and demand uncertainty. FedEx is now expecting adjusted earnings to be around $18 per share this fiscal year, and revenue might be slightly down versus last year. Apple is said to be undergoing a rare executive shakeup that's in a bid to get its artificial intelligence efforts back on track. Sources say Tim Cook has lost confidence in the ability of AI head John Giannandrea to execute on product development. Vision Pro creator Mike Rockwell will now take over Siri. He's expected to bring his technical expertise to the virtual assistant service, which has struggled with engineering and quality problems. Bloomberg has learned UBS is considering relocating its headquarters if Switzerland sticks to its demand that the bank hold an extra $25 billion in capital. Sources say executives believe meeting this requirement would make the group uncompetitive to global rivals. A draft proposal is due to go before lawmakers in May, but any change would likely not be implemented before 2028.
I wonder if they need to change the S, though, if they make that decision. S and UBS. Anyway.
Mystery new location.
1HK is a stock we're tracking very closely today. That's CK Hutch. Out with earnings yesterday. There's the earnings bit, there's the commercial bit, there's the geopolitical bit, right? And if you look at a statement of the company here, warning investors that really the conditions of this operating environment are fairly fluid. The Hong Kong conglomerate reported weaker than expected profits, while a port sale, of course, which I alluded to there, the plants they're facing some rather high uncertainty after angering Beijing. Let's bring in Shirley Zhao to talk us through here, our conglomerates and media reporter, the earnings and the complication that this company faces right now. Was the focus on the earnings, or was the focus on the ports deal?
So I think the focus is on both. So CK Hutchison yesterday reported a 27% drop on profit, and it also warns in its earnings report about the volatile and unpredictable business environment environment, mainly contributed by geopolitical risks and trade tensions. And, what's interesting in the earnings report is that it didn't mention about its port deal with a consortium led by BlackRock.
Yeah.
And also, what's interesting is that CK Hutchison typically would host press and analyst briefings after every year's annual results. But this year, it skipped these events. So it sort of reflects that the sensitivity of this deal at this moment.
And so what does that tell you about how the deal's being, I guess, passed over and whether it's likely to be given the go-ahead or blocked? And beyond that, also, I guess, what stood out in the numbers?
Right. So the latest development is that we learned from sources that several Chinese state agencies have started looking into this deal, trying to find potential antitrust or national security violations. China's top office on Hong Kong affairs have also reposted commentaries from pro-Beijing media criticizing the deal and also calling CK Hutchison kowtowing to Donald Trump and, quote unquote, selling out all Chinese people. So we can feel China's pressure on CK Hutchison, and there are more and more people calling for CK Hutchison and Li Ka-shing to sort of cancel the deal. But we don't know how far China is willing to go to force a private business to cancel a private deal involving only overseas assets. Li Ka-shing has kept ports in Hong Kong and mainland China. And, a lot of analysts are saying if China is willing to go so far as to force Li Ka-shing to cancel the deal, it's going to be very dangerous to Hong Kong's business environment because a lot of Hong Kong business tycoons are going to start to be worried about their own assets. And maybe Hong Kong will see even more capital being pulled out from the city, and maybe a lot of business people are going to start selling their assets.
Can I just ask maybe a point of clarity? Because interesting how you phrased that a lot of people are calling for the company to cancel the deal. And it's not as if a lot of people are calling for the company. The regulators are not telling the company to cancel the deal. So whose call is it? Is it a private company deal? Which regulator covers this, if at all? Whose final decision is it?
So far, Chinese officials have been pretty vague on this. They haven't come out and say, Li Ka-shing, you should give up on the deal. Nobody from Chinese government has been calling Li Ka-shing or CK Hutchison to give up on the deal. But judging from the tone from a lot of pro-Beijing media and from a lot of politicians based in Hong Kong, for example, former Hong Kong leader Leung Chun-ying and current Hong Kong leader Zhang Li, they have both spoken out on the deal, even though they haven't named the people or the company. They're saying that, companies need to be cautious about these kind of environments, and Zhang Li has said that he will handle the deal according to laws and regulations. So we could feel increasing pressure on the company.
Right.
And of course, the company is totally private and it's registered on the Cayman Islands, and only 12% of the revenue it made is from Hong Kong and mainland China. So, this kind of diversification can help the company sort of limit the impact if there is a political fallout.
Well, it's certainly going to be one to track very closely how this deal develops. That was our Bloomberg conglomerates and media reporter Shirley Zhao there. And you can get an insider's guide to the money and people shaking up the finance hub, or Hong Kong, of course, in our Hong Kong edition newsletter. That's out every Thursday. You can sign up via bloomberg.com/newsletters. We'll have plenty more ahead. This is Bloomberg.
Good morning. Welcome back to shows. A big mover in the early goings here is BAIC Motor, Beijing-based OEM, 32,000 employees, out with some prelim guidance here on the likely drop in profits for last year. So we're talking about 950 million is about maybe the net profit figure. That's about a 70% drop from the same period the year before. It's worth pointing out, though, these are prelim numbers. The actual numbers are coming out in about almost exactly a week from today. So just stay tuned for that. Market is obviously reacting ahead of that already.
Yeah. And what else the market is reacting to is some
more guidance from the
policy support for the sector here, for the traditional Chinese medicine. There we go. And as you can see, a lot of these names were actually up by much higher. So we are coming off highs of the day, but it's worth pointing out this is happening against the grain of a market that's overall to the downside right now. So effectively, you have some guidelines being put out here that will be supportive, of course, of high-quality development there of the sector as we push ahead. Just a glance at the benchmark right now going into the first, 24, 25 minutes into the session here, so 0.5% to the downside. We are continuing to see consolidation take place at about these levels. We are on track for a weekly drop across pretty much all the benchmarks right now, from the CSI to the Hang Seng Index. And yeah, go ahead, Belle.
No, I was just going to point out oil is actually extending gains here today, and we have actually seen it rising for a third day. That's after the US sanctioned a Chinese refinery for allegedly buying Iranian oil. So just something to track there as well. One of the notable boxes in the green after, as you said, what's really stocks that are under pressure and ending the week kind of flat. Welcome back to the China Show. Taking a look at a very nice shot of Hong Kong there this morning, but also the Hang Seng looking kind of flat today. I mean, we've really started the week with a bit of a bang, and then in the day since, we've continued to sort of slip backwards, and now looking to end the week fairly steady, I would say, flat, no real change. But still, we've got that big focus on earnings, Dave.
Yeah, we really do, and I think that's probably what might galvanize really markets going into maybe next week when you look at the Chinese market, right? So Hang Seng Index 34% down as far as volumes go. We'll talk more with our reporter April Ma in a moment here on really what this week has been. Change the page, please, and just the general sense of lack of malaise, I guess, is a good way to put it. So we're up about 10 to 1% on the benchmark. S&P futures are flat. We are on track, though, for, I think it's week number 5 on the NASDAQ. The jury's still out for the S&P. So on the S&P, we're actually higher for the week still. On the NASDAQ, currently with a day left, we're down. So a 5th week of losses actually means we're on the longest losing streak, weekly losing streak on the NASDAQ, going back to 2022. That's about 3 years. May of 2022, to be more specific. The other things on deck today, you have the Euro-Dollar. We'll unpack some of the central bank decisions later on. It's been a very, very busy week on the monetary policy front. But to Belle's point, it's really been about earnings this week so far. So let's have a look at what's coming up today, what's coming up next week, and where we are so far on this story. As far as market cap goes, MSCI China is quite a hefty amount, 260 billion reporting today.
Yeah, and of course, Meituan's really going to be the standout one to track. We're expecting a pretty significant bump or jump in profit here, I think up around 20% for sales. But if we do reach that estimate, or what's been estimated, it's still going to be the smallest growth in 2 years for the business. But we could see margins improving, and that's important because, of course, Meituan, like a lot of e-commerce names in China, has been offering lots of discounts to try and lure new customers to the platform, keep them on the platform, and obviously that has an impact.
Interesting that you bring that up because the food delivery business in Hong Kong is Kita, right?
Yes.
Right? And, we all know about Deliveroo pulling back. They didn't mention Kita, but it's a competition. It's a function competition. And I think the Hong Kong story today, as we mentioned that too, is I'm quite excited about... Have you seen the news, the drone delivery on that Meituan might go in? I think it's Kita.
Oh, well, they've started trialling. I mean, we have seen trials of that sort of food delivery in China already. So bring it to Hong Kong.
But how would that work? Would they bring it to you... Because we live in high-rise apartments here, largely speaking, right? So would they take it up to your window? How would a drone...
You know what? I don't know. I know that the Hong Kong government's very focused on the low-altitude economy, but, I mean, frankly, this kind of sounds dangerous.
Yeah. I live on the... Okay, let's put it this way. I live on the 100-plus story building. No, there's no 100-plus story building. No. It's quite high up, so I'm interested to see what the fine print will be here on food delivery and how drones are going to be involved as well. Which is interesting because I was also watching something on the weekend where you have, and this is a true story, right? Drones being used to firefight and fight fires in high-rise buildings. So I think we're using the same dynamic there, except that instead of delivering fire, it's a spicy food maybe in some cases.
Well, the first responder
thesis has definitely been tested. But let's get back to earnings. I mean, we're definitely getting nudged in that direction. Earnings coming up this week as well, something else to watch because there's a lot more coming down the pipeline, and it's going to be more in terms of we've got all the banks reporting. That's going to be one to track. Food space, we've got Haidilao, of course, Nongfu, Pop Mart, Medea.
BYD. Next week.
BYD, of course.
Yeah.
I mean, huge one. And we were saying it's up nearly 60% this year, the stock.
There we go. So far, what do we look like as far as this earnings season is concerned? So we're just moving into the thick of things. So it depends really where you cut it, because this is an interesting time of the year where you have companies reporting for the last year, and then a couple of weeks we'll be entering first quarter earnings season, right? So there's a bit of confusion. And just to mention, when you look at this split, I think we did get some news. I forgot to mention this earlier on, that Evergrande NEV, I believe, came out with a line that they're delaying for the earnings report as well. So anyway, more on that in a moment. Geely was the one that reported overnight, 3x on earnings there, 1.2% to the downside. Why do we get into the thick of these corporate?
Probably time
minutia.
to. Yeah, we're a few minutes into the show now. So Catherine Lim, Bloomberg Intelligence Senior Analyst for Consumer and Technology in Asia, is joining us from Singapore. So Catherine, let's kick off with Meituan. Of course, it's coming out later today, but what are your expectations for the numbers?
Right. Well, Annabelle, Meituan, they've always delivered on earnings as well as revenues. And this is a very scalable business. So we're not expecting, any negative surprises, which was what we have seen from PDD and Anta in terms of margins. Keeping my fingers crossed that Meituan, we're off to a better end of the week with their reporting after market close today. I think one of the things that, the market will also be watching out for, as David has mentioned, Kita. Kita is now not just Hong Kong. Kita is also Middle East. So let's see whether they provide more update on this overseas venture.
Catherine, you talked about PDD here, so you're forcing my hand. Why don't you talk about PDD a little bit more now?
Well, they've highlighted, and I think it's quite apparent that there's going to be swings in their revenue growth and earnings as well as they move into this first 3 months of 2025. And again, the disruptions that we've seen from a supply chain angle. And I think, on the cross-border e-commerce side, all eyes are now on early April to see whether the de minimis rule from US is finally abolished. I think there's been so much talk about, this being delayed to September, etc. But it seems like there may be more clarity in early April. But PDD, again, Temu, the overseas business, they're going to go through a little bit of a rough patch before it gets better for them, hopefully by the second half of this year.
All right, Catherine, thank you so much. Catherine Lim there, our Senior Analyst for Consumer and Technology over in Singapore for us. Let's stay in Singapore and talk about this earnings season in China. Stay with, of course, with the markets. You have tech stocks, of course, in focus, following what's been, I think, the focus of global markets, this rally taking place across Chinese tech. Let's bring in April Ma, our Asia equities reporter, to maybe just, April, we talk to you almost on a daily basis this week, and maybe it's useful since it's Friday, let's take a step back, digest the earnings that have come through, and, your data shows still, the version of Mag 7 that we have in China, for example, and I'm hoping you could outline for us who the Mag 7 are in China, has really proved resilient from a performance standpoint.
Right, so the going version, there's really two versions of China's Mag 7, and I think that the one that's come out a little bit on top in terms of which one people recognize the most is the one that has Meituan and Lenovo. So apart from those two, we have the five obvious, which are Alibaba, Tencent, Xiaomi, SMIC, and BYD. So if you look at the performance against the HS Tech Index, there's still a little bit of outperformance among the bigger names. So last I checked, it was around 6-7%. I think maybe they're a little bit lower today. But again, I think the playbook this week has really just been to sell on fact, given the rally. People are really scrutinizing the earnings for any little bit of reason to take profit off the table. I mean, we had pretty solid capex from Tencent, but people still thought it was rather on the soft side. There are also pretty ambitious moves from the telecoms companies to expand on AI investment, and still that wasn't enough. I think the key thing to watch now is once this earnings volatility is over, which direction we'll head.
Yeah, I'm just taking a look at trading volumes, and I can see for Hong Kong at least, it's more than 80% lower right now than it would typically be on a 20-day moving average basis. What exactly is driving the low liquidity in the session today? Is it just still around expectation for earnings next week? Is it tariff concerns? Is it sort of being caught up in the broader market sentiment?
Yeah, I think, as you mentioned, turnover is the biggest sticking point in this market right now, and that's really preventing the momentum from charging ahead. And it's something that traders are pretty worried about as well. As to the April 2nd tariffs, the investors I've spoken to aren't really paying that much attention to that date, and they're even saying that if there is a dip, that might be a chance to accumulate. I think the earnings headwinds could be more of the important factor in the week coming ahead. We have BYD, we have Kuaishou. Those are all names that have been favored by southbound over the past couple of weeks, and we all know how closely these investors follow these earnings. So for manufacturing firms like BYD, it's much easier to keep on top of their production lines, their orders. So there's a higher chance of sell and fact there.
Okay, April, thank you so much. April Ma there, our Asia equities reporter in Singapore for us. Yeah, still ahead here on the show, we have Kingsoft Cloud and the executive director there and CFO, Henry He, joining us to talk us through their earnings and, more importantly, the outlook, really given, Belle, how fantastic the stock has performed.
Yeah, really very closely tied, of course, to Xiaomi, and it's been really caught up in as well the success of that company. One of the ones that April was just saying there in the so-called Magnificent Seven in China. But first, we talk FX rather with HSBC. That says yen bulls get a boost from Japan's latest CPI data. We'll have more ahead. This is Bloomberg.
Welcome back. You're watching The China Show. Happy Friday, by the way, if you're just joining us right now. So we're wrapping up the week. We talked about earnings a couple of minutes back. It's also been quite a busy week across the central bank space, a series of major central bank decisions this week. You had the Fed, obviously, midweek, then the BOJ. Suffice to say, on your screens, you have everything from the Fed to BOJ, the Swiss, you have the Riksbank there, the Bank of England overnight, Bank of Indonesia. All six actually held. Brazil, I believe, also held. And, of course, the interim one, which came in the form of Turkey, but that's really down to an idiosyncratic domestic issue. They did have to come out, of course, and I think it was a rate hike that they delivered there on the back of, I guess, a currency conversation there. But yeah, I think the takeaway is on hold, but they're really looking at the outlook. And on inflation specifically, I think Jay Powell had mentioned that inflation expectations, they did acknowledge were on the up, but also did acknowledge that part of that was maybe transitory on the back of a function of tariffs here.
Yeah, really tried to shift that focus away from the UMISH survey that we had a couple of weeks back that really showed inflation expectations on a 5- and 10-year horizon moving high to the highest level we've seen in about 32 years. But I think, as you said, the sort of broader theme that came out of the week is just this level of uncertainty, the fog, essentially, of what's going to be happening. But you saw it with the BOE, for instance. They dropped their rate-cutting bias overnight. You saw it with Sweden's central bank as well, saying that the easing cycle is over. So it's really just that high level of complexity to understand what's ahead. And it's very, very difficult to predict, if you even can predict what's going to happen. Yeah,
I think to the point Belle was just making there, right? So the Bank of England, for example, in the rate decision, a lot of focus was really also on the voting split, which I think is indicative really of future intention. Let's get a better sense really of what to make of this. We're joined by Joey True, head of Asia FX Research at HSBC, joining us out of Singapore today. Joey, very good morning to you. Happy Friday, by the way.
Good morning.
What's the key message for you going into this weekend?
Right. I think the key message is that, the markets are still focused on the U.S. recession concerns. Despite what Jay Powell said, I think market remains, unconvinced that the economy is totally out of the woods. And I think the data continues to be very mixed, right? The soft data, sentiment-related data continues to come in weak, but the hard data is not that weak. Like, for example, retail sales, IP, even yesterday's last night's home sales. So I think there's still a healthy debate going on. So the dollar is still finding it hard to gain traction.
And yeah, just on that, I mean, what is the dollar direction then?
Our view is that the dollar should continue to actually move higher into the tariff headlines, especially in the area that we are in right now, especially in Asia, because Asia is really bearing the brunt of a lot of the tariff risks. So dollar Asia actually never really lost that dollar or Trump premium like the DXY index did, right? Because of euro and yen developments. So dollar Asia always remained quite elevated, and we actually see that continuing to be a little bit more on the upside into 1st and 2nd April.
Yeah, Joe, if I could ask you too, I mean, on the dollar, right? When you look at what the Fed told us this week, it's 2 cuts this year. The market still is closer to 3, if not at 3. I know you guys have a call of 3 25 basis point cuts this year. But is that it for this cycle, is my point? Is it either 2 or 3 max?
Yeah, so HSBC's view is slightly different, is that we're only calling for 3 cuts this year, but no more cuts next year, right? So markets can still be a little bit divided about the pace, right? I think at the end of the day, we need to understand, the U.S. data. So like I said just now, the split between the soft and mixed, something has to happen. Either the soft data, the sentiment data is too weak, or the hard data is just yet to decline relative to the sentiment. So I think in the coming months, we will be able to get that clarity about how many rate cuts are really needed this year.
And just on that point as well, I mean, if we see sort of fewer or less easing from the Fed, that does have knock-on effects in Asia, of course. Which currencies are most vulnerable then?
I mean, look, a lot of Asian currencies right now are trading more about the tariff risk or the growth risk that is coming from potential weaker, slower U.S. Growth, right? So either way, be it tariffs directly on Asia or this transmission from slower U.S. economy to Asia, it's still disinflationary for Asia. So I think that is the main theme and the main challenge for Asian currencies right now, coming from the external side. And people are less focused on, the Fed, what the Fed is doing. I mean, if the Fed is cutting because of U.S. recession risk, that still can't be good for the Asian economies.
Yeah, but talk to us about ASEAN specifically. We had a rate decision this week, of course, out of Indonesia. We've been speaking. I'm not sure if you were able to catch an interview with the Bangko Sentral in the Philippines, and they're guiding towards a few more rate cuts, if I'm not mistaken. There, what is the outlook for ASEAN rates? How much scope is there to the downside for this group specifically?
I think this group is quite mixed. So we have, some economies that are a little bit slowing down in terms of their domestic demand. So for example, Indo and Thailand, they stand out, right? And also if you look at their stock indices, it's quite clear that these two markets are a little bit on the weaker side. So clearly that their central banks are looking for opportunities to cut rates, to, shore up domestic growth, even without talking about the external challenges, right? Domestic growth is already quite weak. So they need to shore that up. But, the external conditions, the volatility can sometimes get in the way in terms of the timing. So we saw that with Bank Indonesia this week, sort of refraining from a rate cut, even though they keep guiding that they are trying to do more rate cuts down the road. So for us, I think at some point they need to get used to the fact that IDR might just be weakening for some time.
What about Japan? Because the stage is really being set for further hikes from the bank, even if they still maybe want to wait till the summer, maybe. But we have the inflation figures out. We had the wage negotiations as well. What's the direction for the yen from here?
For us, actually, our view on BOJ is that they hike roughly once every 6 months. I mean, it can be once every 5 months or so, depending on what's going on with the yen and some other financial market developments. But I think roughly the once every 6 month pace or so is about right when we think about potential growth still being, economic growth still being roughly slightly weak, as well as, just the overall cautiousness given that the global environment is not that conducive for exports. So I think that's our point. That's our view right now. And this week's BOJ actually does not give us any hint about whether the next rate hike is going to come in May, June, or July.
Right, and I think the other part of Belle's question, I believe, was where you think the exchange rate is going to go. Let me embed that differently. I'm going to Japan likely this time next month. Do I exchange my money now or next month?
I think you can. I think it's fine for you to actually wait a little bit, because the dollar yen is susceptible to some kind of decline if risk aversion gets worse, right? So as we see from last month, during periods of risk aversion, actually the yen comes out, quite a good contender as a safe haven currency, sometimes even better than the dollar, given the concerns about the U.S. economy as well. Of course, we understand that Japan is also susceptible to some tariff risks, right? For example, on automobiles. So yeah, that could also limit some of its gains. But at the end of the day, I think it's flat to maybe slight downwards is our view for dollar yen in the near term.
And we've tracked sort of the yen bulls. There's also the euro bulls as well. Just broadly, how are you thinking about the euro appreciation, the depreciation pressure it can put on the greenback? Any views on that?
So our view on the euro is that a lot has been priced in when it comes to what's going on with German fiscal. So in terms of the economic implications, it may not actually happen that quickly. I mean, obviously this is a big moment for Europe politics, but in terms of the economic impact, the near-term impact from the tariffs might actually overshadow the long-term positives from this extra spending. So for us, some of these improvement in the European sentiment in the euro is right, but we will not extrapolate further going forward.
All right, that was Joey Chu there. Thanks so much for joining us. Have a great weekend. Head of Asia FX Research at HSBC. We'll have plenty more ahead. This is Bloomberg. Here are some of the major political stories we're following. And Indonesia has passed a law expanding the role of the military, allowing active duty personnel to assume a broad range of civilian positions. It also increases the scope of non-combat military operations. The measure alters curbs installed 2 decades after the Suharto dictatorship. The Parliament's move sparked protests in Jakarta, with hundreds gathering outside the legislature calling for lawmakers to reverse the changes. Elon Musk is suing the Indian government over content regulation and censorship of X. The social media platform has accused New Delhi of issuing arbitrary and erratic takedown notices. The move coincides with Musk's effort to launch Tesla and Starlink satellite internet service in the country, both of which are awaiting regulatory clearances. A Maryland federal judge has temporarily blocked Elon Musk's government efficiency team from accessing the personal information of potentially hundreds of millions of Americans who receive retirement benefits and other payments from the Social Security Administration. Musk has called the Social Security program a Ponzi scheme. The agency paid out more than $1.5 trillion in benefits last year.
Right. Let's take a look at markets right now. Pockets of this equity market. Start things off over in Seoul and some of the Hanwha Aerospace there. And, there was a stock offering plan, and you look at what some analysts are saying. They've effectively taken down on Hanwha Aerospace here the target for the stock price here on the back of that cash call. And as you can see, shares are responding to the cash call, and of course, analysts are then responding to this massive drop in the stock price. We're also looking at Yeah, go ahead, Bill. You say something?
No, Apple. I mean, I can.
Oh, yeah. Talk about Siri, actually. Yeah, go ahead. Yeah.
I can talk about this one because I was covering it earlier for the Asia trade. But essentially, we're taking a look at some of the supplies today because there's been a reshuffle in the management ranks at Apple. So essentially, a man named John Gianandrea, he was hired in 2018 to head up all of Apple's AI. Yeah. There's a sense that we're getting, this is a Bloomberg scoop, but from sources saying that Tim Cook, the CEO, of course, has lost confidence in his ability to execute on product development. And so they've got a new person now in place to look after Siri. That's Mike Rockwell. And he is the person who brought the Vision Pro headset essentially to life. So that's the story there for Apple, but not really seeing any sort of reaction.
Yeah, just do it, I guess. Speaking of Nike-related stocks on your screens, we were talking about this earlier with the earlier guest. Inventory is picking up, and really that's down to consumer behavior and confidence moving forward. Shares are down, plenty more ahead. This is Bloomberg. Right, good morning, and we are just entering the last half hour of the China show for the week here, going into the Japanese lunch break, suffice to say, and it's a quiet day. I mean, inflation came out earlier on, a drop from the previous month, but as you can see, higher than expectations here. We're slightly higher on the equity market. We're not really doing a lot in the currency market. And the 10-year yield, as has been the general direction of Japanese government bond yields of late, has really been up. Right. Very, very quickly, Asia, outside of Japan, is doing this. And we still have a full day left in most parts of the world, but looks like fund managers are now turning to the weekend and looking to transform into fund managers. We'll see what that looks like going into the weekend. But it's quiet out there. It's a week of consolidation. Book those profits where you can and in which market that's appropriate. And, of course, we're looking ahead to earnings season. A lot of earnings next week, plus suffice to say the next 2 weeks is fraught with risk, with reciprocal tariffs and what have you, Bill.
Yeah, but as we await those numbers, I guess, it does have that sense that the weekend's kind of started
It's here.
Started a little bit early.
We're there in 30 minutes. We're there in 30 minutes.
But earnings a big focus. Yeah. And one of those names earlier this week was Kingsoft Cloud. It's a Hong Kong-listed cloud computing solutions provider. It's been actually one of the best performing.
Check that out.
Yeah, surging more than fourfold. You can see the very dramatic run-up for the stock. Now, the company saw its full-year total revenue rise more than 10%. It narrowed its net loss, and that's because it's seeing strong demand from AI business, enterprise cloud projects as well. And joining us now exclusively is its Executive Director, also CFO, Henry He, joining us in the studio this morning. So thanks very much for coming back on Bloomberg Television again. I want to start off with, the rally that we're seeing in the stock, also the growth that you saw in the latest reporting period. It's very much linked to the success of Xiaomi as well. So can you just also spell out that customer relationship and how important that is for Kingsoft Cloud as well?
Yeah, sure. Thank you for having me. Thanks a lot, David. Thanks a lot, Annabelle. So I think before I kind of recap on earnings, also want to mention that if you really look at the Xiaomi plus Kingsoft group as a most probably today powerful and influential ecosystem company and a technology company today, we actually enjoy a great benefits to serve them as a more exclusive cloud provider for them. If you think about back to basics, basically, when you think about AWS, it's actually coming because of the strong base of the Amazon business. And also because of the cloud business is strong and Microsoft is very strong. So my view is giving a very good, strong demand of the consumer business, EV cars, and also the WPS. We have about 600 million users in Kingsoft Office, WPS. We actually have a very strong basis to use a cloud from consumer internet, from our production tools, and all different verticals of the applications. So that actually drive a lot of the user scenarios of the Kingsoft Cloud business. So that's actually on the volume side. But also if you look at on density and the different applications, if you think about all the different verticals, the cloud actually drive from a traditional IaaS-related, very simple layer of the IaaS services to today is a more integrated model because the data need to fit into the model getting better on every single day, and the outputs has to be really on a real-time basis. Historically, if you think about that, is storage, data networking, and computing can be allocated among different vendors, but today, the client really appreciate only one vendor can go with all the full stack solutions. That actually gives Kingsoft Cloud a very good position because we're working with the client not only on a single layer of so-called IaaS services, but we actually go up from IaaS to PaaS level services and providing a lot of good solutions to help them to really use a model as a production tool to generate workflows and to generate final efficiency of the output. So that's actually a dramatic change from the traditional IaaS to a more integrated MaaS services.
And does that make future revenue more or less predictable?
I think it's more visible. I think two things. First of all, as you know, I call it more from the supply-driven to the demand-driven. So historically, because we serve the large accounts, but today, as you know, we call this AI democracy, right? So the cost of investment to AI is actually bring lower a little bit because of the DeepSeek and all the topics we can talk about, and actually help us because we want the diversified client basis. And the lower cost of the investment for the client actually can expand our client universe. But on the other end, use AI is actually require a much higher technology know-how and experience.
Right.
So that combination will help the cloud provider like Kingsoft Cloud because we want a long tail of the mid size of the enterprises who actually want to use AI, but without the DeepSeek and all the new technology, the investment and the barrier to entry to AI technology is much higher. But today, given the DeepSeek and all the things, more clients in the recent conversations we feel they want to try these new things, right? Historically, saying, I spend you to 10 million, 20 million to just start to do that. But today, a few $1 million can help any clients to really drive their internal process.
So you see more enterprises, I guess, beginning to use AI services, and that can also drive demand for Kingsoft Cloud's products. How do you compete, though, against the emerging hyperscalers in this space? And I'm talking about Alibaba and Tencent in particular.
Sure. Another key word I want to say is we used to think cloud business is a scale business. Right? Scaling is important, you lower costs, but today, I think scale is still important, but more importantly is how you help the client to drive the value from AI as a production tool for renovation. So I'll give you a few examples. For example, today, when you talk about, for example, the digital auditing, right? When we're working with auditing firms, we're talking about the user scenarios to help the lawyers to drive and drafting better contracts and to save time to be more efficient. And those type of tools, you need to really understand client needs. And basically, you need a very thin layer of consulting services, provide solutions, help client to really go deep and deploy AI capability. So that actually the full stack of the services value. So my point is, if you really go deep and have a close relationship with a client will actually go with you. So my point is, historically, we need to go shopping, find good clients, but today, the client is actually coming to us because right now, not many cloud companies do have a good knowledge on the industry know-how, and that actually is our expertise. And given we have a proven success, for example, to serve co-pilots for WPS, over 600 million users, to serve Xiaomi for the new cars and the new mobile phones and robotics, and given we have a strong relationship to serve enterprises and all the traditional industries whose knowledge about AI is relatively lower penetrated. And those are a lot of work we actually can do and probably can do better compared with other peers because, Kingsoft has been in business for over 37 years, and we have many, many large corporate accounts, and we can do a lot of cross-selling, which is actually very unique if you compare with other cloud providers in China today.
Right. And I guess it's good to be connected, say, like the Xiaomi relationship only gets bigger and, to your point, deeper, and those switching costs go up. How concerned are you of customer diversification? Let's put it that way.
Yes. I think it's a very good question. So my view is you need to look at the near term and the kind of the medium term. In the near term, I think probably already noticed that there's a great momentum for Xiaomi and Kingsoft ecosystems, become more influential from different verticals. So I think we need to grow with them. So my point is, number one principle is go to basics. To serve Xiaomi pretty well, so that will help us to train a good technology in-house. And as you know, the beauty of cloud model is you need to have a very strong basis, and you use that to lower the cost of procurement, supply chain. You're basically sharing the resources with different companies. So the diversification is important for the medium term if you really want to drive the profitability, because the efficient need to build on need to be built on a large foundation. So I think for the short term, we'll go to basics to serve Xiaomi because it will go with a great momentum to growth. But also going forward, I think utilization, efficiency, sharing of the resources, and putting the know-how into all different verticals to capture kind of the mid-tier of the enterprises usage is actually important for us to improve the profitability. So we're kind of taking on 2 different steps.
You mentioned the different verticals, and you mentioned as well Xiaomi exploring robotics. This is a very hot market right now in China, and there's a lot of different companies that are sort of starting to emerge in this space. How big do you think it can be for your business?
Yes, I think generally speaking, my point is I use the word of tip of the iceberg. The cars, robotics, people when see that physical expression of AI in the room or on the road, it is only probably the last mile of the AI usage because most of the AI is embedded into the chips and all the sensors in the physical items. But my point is before the thing become real, simulation of the data, building the algorithms, saving the data, doing all the digital mapping, and all the things actually has to be built much earlier before the cars and robotics on the road. So my point is when we look at our revenue pipeline, that actually also important for us because all the R&D spending and the pre-research are important for cloud provider to help them to really build their future for the R&D process. And if I may also want to kind of recap quickly on the numbers actually reflecting on this topic because a few things. I think we are moving really 2 years ahead because before we announce the earnings this Wednesday, the consensus on Bloomberg is probably going to be profitable in 2027. But we're actually moving 2 years ahead on the operating profit margins because of a few factors we just talked about. Diversification, go to basics to serve Xiaomi, and make sure we give client a good know-how and technology, and rather than compete on the commodity business of the ICE services, which we did many years ago. So that's one part. The second part is we deliver about 30% of the YOY growth. The consensus is only 20%. So the last point is, as you know, in the past few years, our lowest GP margin was only 1%. Our EBITDA margin was negative 20%, but this quarter, our GP margin is around 20%. Our EBITDA margin is about 16%, which is a huge improvement. So we actually deliver a great turnaround story for the past probably a year or two and actually reflecting the share price and the valuation in the past 100 days. And I think all the factors we just talked about, diversification, sharing, efficiency, and really change from scalability the game to a more know-how and a technology value add. I think that's actually a few things we are kind of working on. And hopefully it's going to continue to deliver. And hopefully 2025 will be a good year. I think we are going to maintain a full year profitability on the OP side as our target. And I think our growth on the top line will be accelerated in 2025.
And let's also talk about the investments that Kingsoft has been making, or Kingsoft Cloud has been making into AI in particular, because it is such a developing landscape in China. Yesterday, we actually spoke with Kai-Fu Lee, who is the chairman of Sinovation Ventures, also the founder of 01.ai. But he spoke to us about how many tools or AI models he actually thinks can dominate in the end. Just take a listen.
I think probably, I'm guessing 3. DeepSeek, Alibaba, and ByteDance. And they'll evolve over time, right?
Okay, there's a few names missing on that list.
Yeah.
Only 3.
Well, there will be many other who aspire to build one, and we'll see if there's a 4th player. But even within these 3, I think DeepSeek currently has the momentum, and that's why we're embracing that.
I'm curious for your views on that one, because I know that you've made investments in names that aren't on that list that he mentioned.
So before I come to my comments, I think another key word is also about so-called AI factory, which basically Jensen Huang is always talking about in the media earnings calls. So that actually is an emerging concept. My point is the model, which reflecting the algorithm and intelligence, the data, which actually is the input and output of the intelligence. And third part is a computing power, basically to help link up 2 things together. My point is all 3 are important in today's environment. And you need to really, one company cannot do everything. So that's why I totally agree. You need to find an AI factory that can link up a capacity from 3 different layers and dimensions. I think Dr. Lee is right. the model itself is important, and we do feel there's a huge debate regarding the closed model versus open-end model and what's the value of open source communities. I think I'm in a view that more model will be good for our business because we are going to build the AI factory, as Jason Huang mentioned, that actually combine our computing power, industry know-how, algorithm, and the data. So we actually combine all the three key elements to generate AI as a final value tools. So the model itself will great import, but my view is I think going forward, they will be concentrated in a few different models, but the technology path will go down deeper because the model need to solve real-time and real-world issues, and you have distributed models, so-called smaller size model, can be installed on the devices, on robotics, cars, and maybe on some co-pilots, and become real agents. I think those models will be a reflection of a large model, but my view is a large model is a foundation, but probably not many companies has to compete on that area, but what's kind of linking to the final output of the value is more important, and we are trying to be positioned as a value chain in that close and loop and closer to the final users. That's actually my point.
Well, it comes down to money, and you're the CFO. You mentioned that you're ahead of schedule on some of the profitability.
OP margins, yes.
So, well, do you think you'll make money this year? Do you think you'll turn profitable this year? That's number one.
Yeah.
And number two, do you think you need to raise money, given the runway you just laid out for us? And how do you figure out how much money do you actually need?
Thank you, David. It's a great question. So I think as we all learn from financial theory, right, my EBITDA margin is a leading indicator for my cash flow and EBITDA is a leading indicator for my OP margin. So as I mentioned, my gross margin increased about 20%, my EBITDA margin right at 16, which used to be about negative 20, and my OP margin move ahead 2-year schedule. So last quarter was OP margin operating profitable, break even. So my point is our goal is to for the full year 2025, we try to be profitable on the OP margin side.
On the OP, okay.
Yes. So second point regarding your question, I think today I also encourage the market and investor look at AI not from a more supply side driven economics to a more demand driven. My point is, we used to do the budget by saying, oh, this is what I have today,
right,
and this is what I can get, A plus B, this is my budget for C, which is this year's target. I think given the AI, we do see a lot of strong demand, especially after DeepSeek. More emerging clients, actually, especially as I mentioned, mid-sized clients, they want to try and use AI. That's actually very strong demand. So my point is we need to really switch the focus from what we can do to what market wants. And we use that to drive our budgets. To close your question, my view is as long as the demand is there,
right,
we will always find a way to finance in the company, to grow the company. I'll give you just one example. In the last few quarters, we basically grew on the top line, as I mentioned, 30% year-over-year based on all the public earning numbers. I think we are probably the number one in terms of YOY growth for last quarter. But if you look at my cash flow, last 3 quarters, we are cash flow positive on operating cash flow. We didn't raise any capital, but we also found a good and the most optimal way to financing, for example, acquisition of the assets, so on and so forth. For example, we have the off-the-balance sheet leasing agreements. We have operational leasing agreements for data centers, capital leasing for the servers. We have the client payment in advance to financing the short-term client utilization because given the strong demand, the client actually willing to financing some of our purchase for going forward incremental demands. To close the question, I think we're going to be very prudent and manage the balance sheets and make sure that the demand can be met, but there's more financing tools we can use today rather than the traditional tools.
Henry, fantastic. Thank you so much for outlining that. And yeah, balance sheet flexibility, as they say, of course, is key here. Henry He, the Executive Director and CFO at Kingsoft Cloud. Okay, breaking news. Heathrow Airport says things will be shut today because of a power outage. There's a lot more detail coming through, and you can check that out online at the on the website here. Effectively, there's a fire at an electrical substation, which is, based on what we know right now, leading to an outage at the airport March 21st. That is today. So we'll keep you abreast of developments here. Plenty more ahead. This is Bloomberg. Welcome back. Welcome back. You're watching the China Show. Let's talk about President Xi Jinping and the government there. They're set to welcome a U.S. senator close to Donald Trump for talks in China. Both countries are trying to move forward these trade talks that are said to have stalled at lower levels. Let's bring in Stephen Engel, our Chief North Asia correspondent, to talk us through the details here. And, will politics prevail in these talks here?
Well, politics is kind of prevailing in business sentiment right now between China and the United States, obviously, with the Trump administration imposing now up to 20% of additional tariffs because of the fentanyl issue. But I think the China Development Forum, which is held annually at the Diaoyutai State Guest House in western Beijing, is going to be a little bit more poignant and more consequential this time around because it is Trump version 2.0, and there has not been a lot of high-level dialogue. Steve Daines, he's the Republican senator from Montana, kind of going to go to the CDF as an envoy of President Trump. He's not the ambassador, obviously. That has not been confirmed by the Senate yet, David Perdue. But Steve Daines is on the Senate Committee on Foreign Relations. He's on the Finance Committee. He was also a part of the negotiations, if you will, in the Trump trade war version 1. He had dialogue with Liu He, who was the negotiator for Xi Jinping back in 2019. He lived out in China and Hong Kong for Procter & Gamble for 6 years. So he's going to go there and will be the the highest level U.S. official since Trump came back to the White House to meet top senior Chinese officials. Is he going to meet Xi Jinping? We don't know, but it's going to be top level.
Well, Steve, I think we've run out of time for your follow there. I'm sorry, but definitely want to know how much they're going to be rolling out the red carpet.
I'll be there.
Yeah, you'll be there, and we're looking forward to your reporting as well next week. So safe travels, I guess. That was our Chief North Asia correspondent, Stephen Engel, and we'll have plenty more ahead. This is Bloomberg. All right, taking a quick look at some of the movers in the session so far today. These are some of the cobalt and copper names that are listed in China. So the story here is that China is essentially planning to add to their strategic reserves of key industrial metals. It includes some of these names, and that's to try and boost the resilience of the critical minerals supply. So there have been some price inquiries that we're hearing. We're hearing that some bids are also being sort of talked about for some of the metals, but certainly it follows what we've seen in recent years, which has been that tendency towards stockpiling.
Yeah, well, we'll continue to follow that, but as you can see, it's already playing out across this. And, make no doubt, this is not the end of the specific story. Somewhat related to that as well, when you pivot back and look at what's taking place, and, by the way, we woke up here in the Asia-Pacific with, of course, Donald Trump signing the executive order, effectively looking to secure more critical mineral stocks. Miners are down. As you can see, in Australia, it's playing out in the equity market there. Very quickly, oil, please, change things up. Very commodity-focused market roundup here. And, yeah, as you can see, oil is on the way up. You can see some of the names related to oil, and Shanghai Oil is playing some catch-up there, 2.2%. Let's end the show here just very, very quickly on this breaking news. Why don't we kick things off here with news out of London and the Heathrow
exactly.
Airport.
So Heathrow, essentially, this is the story this hour, that the airport is going to be closed March 21. That's due to a power outage. There's been a fire at an electrical substation. So we can see here that it's going to be shut really for the full course of the day until 23:59 March 21. So something that's, of course, going to cause major flight disruptions to what is one of the world's busiest airports.
Okay, keep on top of the story, online, on the terminal. That's it from us here on The China Show.